Did you miss the hidden story? Did you miss the recent climb of 10% in equity markets? The media would have you notice what's on the left. Markets tumble 2% in one day. But on the right hand side we have another article, but it's buried, how the equity markets are fending off the bear. The media wants you to notice what's going to have you watch so they can sell more advertising. But you as an investor have to have knowledge of what to notice, observe, and assess to take care of you, and those oftentimes are not the same as what the media wants to do. What happened recently? October 3rd through the 21st, roughly a 3-week period, we see that the Dow and the S&P are up over 11%. For the year, the Dow is up +2, the S&P is roughly flat. Out of this article in the Wall Street Journal, I love this quote. It says, there are so many people who are out of the market and are now saying, gee, I just missed 10%, said Mr. Marshall, the managing director of Knight Capital. And he said, I can't afford to miss the next 10% up. Wrong, Mr. Marshall. You can't afford to miss any 10% by not being fully invested. Why? Let's look at the meaning of missing 10%. Let's say you're out of the market and you missed the last 3 weeks. On $1 million invested, that's $100,000. But the opportunity cost does not stop there. In 10 years at 7% returns, money doubles. It means you've missed out on $200,000. And in another 10 years, in other words 20 total, now you've missed out on $400,000. What does that $400,000 mean to you? That could produce an additional $1,300 a month of retirement income to pay for health care, for food, for rent, or for utilities. In other words, your survival. This is what you need to know. Inter-year falls are common and are to be expected. If you want to get the returns from equities, you have to be willing to take the risk of equities. I'll send you this chart if you email me so you can see the whole thing, but I'm only going to focus on the last 2 years. In 2009, there was an inter-year decline of negative 28%, but for the full year, it ended up positive 23%. That's a swing of 50% in 1 year in 2009. And more recently, in 2010, there was an inter-year decline of negative 16%, but it still ended up the year of a positive 13%, which again is a swing of almost 30% in 1 year. You have to know what to notice, what to observe, and what to assess to get superior results with your investments. Secondly, you have to maintain your long-term moods that are appropriate for gaining wealth. What are those moods? One of resolve, one of discipline, one of passion, one of ambition. You have to keep centered in the principles that you know win in the long run. And last but not least, stick with your practices. Not just some of the time, all the time. Practices such as rebalance, owning equities, staying fully invested, diversifying across multiple market segments across the globe. Remember, your survival is on the line.